to assume that at the moment. I mean, we all know that nothing bounces better than a dead cat. And the real problem is that none of the structural problems have really been addressed so far. So, we've gone from a situation where, people were suddenly aware of all the problems that have been there and perhaps, overreacting to those to now, they seem a little bit too complacent. I think the reason why we think that the problems haven't gone away is, the reason they're rallying is because people weren't frightened by what the Fed said, but we were terrified by what the Fed said.
Paul, I'm hearing you a fairly hawkish tone, really, considering the circumstances. And we learned that Ukraine is not something they're considering in terms of its impact on growth, but more its impact on further fueling inflation. If you consider some of the language that we've heard about a 50 basis point rate hike and the trajectory that every meeting's a live meeting, does it make sense for the Fed to really move on interest rates earlier and then perhaps just pull back a little bit later on, given there is a lag between such a blunt instrument being used?
Yeah, well, exactly. Look, I think the problem is that we saw the interventions in 2018. We saw that the problems that caused and the damage that caused, but that was into a much healthier economy, much healthier market than they're hiking into right now. So hiking into this kind of fragility, it's very hard to imagine that they're just going to reach a point at which they can say, okay, the supply shock inflation's gone away because we've destroyed so much demand. Now let's just turn the demand back on again and everything's going to be fine. I just can't imagine that everything will be fine in that scenario.
Can I just ask you a little bit more about demand then already? Because we've seen US consumer confidence just starting to slide away from some of those higher levels. Does this tell us something about Main Street, how Main Street is feeling about the pressures that they're facing every time they go to the pump, every time they go to the supermarket and beyond, that they are facing those elevated costs now? And perhaps they've already dwindled or used some of those excess savings at this point, in contrast to Wall Street, which continues to push the stock market higher.
Well, exactly. I think that's the real dichotomy. It's been the dichotomy for a number of years, and it's just becoming more and more real. I think the thing for us is that real measures of demand. If we look at oil consumption isn't going to be higher, certainly not significantly higher than pre-COVID. So this is not a demand issue. And if we see all of the inflation spikes, everybody was talking about timber last year and the year before. We look at timber. Whenever we get a spike now in these commodities, that spike is always lower than the previous spike. So that's telling us that inflation is actually coming down of its own accord. Yes, it's taking longer, but supply shock inflation, it's coming down of its own accord. Actually, cratering the demand side is not going to help that. It's really not. And it's just going to, like I say, it's just going to leave a problem behind. It's not going to help people at the gas pumps. It's just going to leave a big problem behind that when those people don't have jobs and don't have the income to pay for that gas, that's when it's really suddenly going to turn ugly. And I don't believe that the Fed are nimble enough to be able to, pirouette on a dime and suddenly turn all the taps back on again.